that single family being super easy to manage, no issues, tenants handling everything. And I forget I own this place. A check just shows up in the mail to they move out and oh crap, I got to go over there and I got to fix up this stuff. I got to spend a whole bunch of money. I got to show this place. And it just becomes a job out of nowhere that you weren't expecting. And it feels inconvenient.
You have found Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. Downloadable audio episodes can be found in the podcast link found at drawincustomers.com. We are locally underwritten by the Bank of Sun Prairie, Calls on Call Extraordinary Answering Service, as well as the Bold Business Book. And today we're welcoming / preparing to learn from John Casmon of Casmon Capital. Today we're talking real estate. So, John, how is it going today?
Hey, it's going great. Thank you for having me on today. Excited to be here and really appreciate your time.
Yeah, this is cool. So, when I was looking at your bio, it mentions essentially that you're helping people invest in real estate, if I have that correct.
Yeah, absolutely. So we really do two things, right? So we work with folks looking to invest in multifamily apartments, and we help in two ways. One is through education and kind of showing them how to do it. The other way is through passive investment opportunities where they can actually invest alongside us in our deals.
All right. So, when you say multifamily, is that anything duplex and higher, or is there a minimum where there are 50 units or something like that? Or where's your sweet spot?
Yeah, so for us, we're typically looking at 50 units and up, usually 75 units and up, depending on the location. But multifamily technically covers anything that is 2 units and up. So someone can invest in multifamily with a 2 unit or a 3 unit. And then commercial multifamily is 5 units and up. So, but in our world, when we're talking about multifamily, we're talking about kind of mid-size to large size, 75 units to say 300 units is kind of where we play.
All right. We got a lot going on with that market now because I know when I drive around, I'm just outside of Madison, Wisconsin, anywhere, well, really anywhere that I've been in the past month, couple months over the country, it seems like there are apartment buildings going up everywhere. And my first thought is, who's living there? But then I've talked to other people and they say there's a housing shortage. So can you speak on that?
There's a massive housing shortage. So there's a report that, we really need to be building a certain amount of homes every year. And we've fallen way behind that. If you think back to not just kind of the current economic environment, but go back to 2008, 2009, we really never ramped up properly from that time frame. So there's a big housing shortage that's here in the country. The problem is that even the stuff that you're seeing when you're driving around, most of that is higher end class A, maybe luxury apartments. We're
Mm-hmm.
not providing affordable housing. So those folks who are, really looking to rent workforce housing, they don't have a whole lot of opportunity. So what ends up happening is we're really oversupplying kind of that top end luxury units, but not having enough supply that's affordable. And that creates kind of a gap in the marketplace. So we try to focus more on the workforce housing area where we're creating more value add deals, finding nice homes, renovating those apartments so people can live in them. But there is a gap. And I'll tell you this too. One of the things that's happened, you talk about driving around seeing all these apartments over the last year, and for the next year, we are seeing the most housing development, or particularly multifamily development, than we've seen in 36 years. So
Whoa.
last year was the highest in 35 years. This year is going to be more than last year. So it's a gap because we went so long without really seeing any development. And then because everyone saw the growth and the explosion, everyone ran to start developing new apartments. But again, typically they're the class A luxury apartments. And now we're building more than we've ever built in the last 35 years. So we're starting to see rents actually come down because in some markets, not all markets, but in some markets, we're seeing rents start to come down because of the new supply that's coming online.
Interesting. So, what does that do to you as an investor if rents come down? Because I imagine your math was based on rents at a given level or expecting them to go up a few percent every year or something of that nature.
Well, I think the important thing to understand is that real estate is local. And this is where all that is critical. So it does nothing for me because what they're doing in the luxury space doesn't impact my space. And I'll give you an example. Someone who's looking to pay, if you want a luxury apartment, let's say for 1 bedroom, your rent may be $2,000, right? Somewhere between $2,000 and $2,500. Well, if they're brand new apartments coming online and they're charging $2,500. They may have to do concessions. So they may have to say, hey, to get you to leave your current place and move in here, we're going to give you 3 months rent free, or we're going to give you a flat screen TV or something, right? We're going to give you something to incentivize you to move in here. But when they're doing that, in order to keep those residents, your competitors now have to lower their rents or match those concessions. That's at that $2,000 range for that one bedroom. We don't play in that space. Our people are typically paying, say, $1,000, for that $900 for that one bedroom. They were never looking at that 2,000, 2,500 apartment. It's not relevant to them, right? It's like luxury cars having to compete with each other versus the used car lot. So for us, it doesn't really compete because in that workforce space, they're not developing brand new. They don't have those same level of options. So we can go in and renovate the properties that we're looking at, and we can attract those residents because we can provide a better quality unit. So there is still some impact. I don't want to make it sound like they're not related at all. Certainly, if that gap between what a brand new luxury apartment is renting for and that renovated apartment, if that gap's not that far, then someone's going to pick the new place, right? But usually in our markets, there's a wide enough gap where people are happy to take the value offer that we're providing.
Gotcha. So you mentioned renovating. Is that the majority of the apartments that you deal with are ones that you buy, renovate, and then rent out?
Yeah, because we work with investors, our plan is always to really optimize returns for them. And the way we do that is we go in, we try to find a property where there's value that can be created. That value typically comes from renovating them, right? So we can go in, renovate those units, bring them up to current day standards, and then we can charge more in rent for those units because there's more demand for that asset. So that's exactly what we do.
Gotcha. Now tell me about the investors. You mentioned, I believe, something in your website, something about helping essentially entrepreneurs, other business owners that have they're just making their money other places, but maybe they got some excess cash. They want to throw it in investments of real estate, but they ain't got the time to deal with some of the headache that has to do with investing in real estate or just investing in anything else, whatever that is. So, can you tell me how you target them and I guess how the transaction works? What kind of returns? Just tell me if I'm an entrepreneur and I found this bag of money because my business is going well, but I'm also working 90 hours a week. What do I do?
Yeah. Well, let me answer that second. Actually, I want to give you an example or kind of tie in what you're just saying, right? So, who is this for? So, first of all, I was that person. My friends, family members were that person. And who we're talking about is people who make money and they know they want to invest. They've read how great real estate can be. There's a quote that 90% of the world's millionaires make their money in real estate. So, we know real estate is a powerful wealth generation tool, but most of us don't have the time, energy, patience, or interest to actually learn everything it takes to be a successful real estate investor. When I was really starting out and starting to get traction, I would tell my friends, hey, here's what I'm doing. I bought this 2 unit, I bought this 3 unit. Here's how the numbers work. Here's how you do it. And I'm trying to get them to do the same thing. And they would just look at me and say, man, it sounds great, John, but it also sounds like a lot of work. I'm not interested. And it took a minute for me to realize that they just weren't interested in doing all of that work. But once they started to see the kind of money we could make in it, they said, well, why don't I partner with you? Why don't I invest? You go do all that work if that's what you want to do. I'll invest with you and we can do it that way. So that was really the origins of our company and working together. We wanted to work with like-minded individuals who were hardworking people, had good jobs, were making money, but didn't want to put it all into the stock market or into their 401k and wait until they're 65 years old to tap into it. So this way they can invest now, they can grow, they can learn. And most of the people closest to me who've invested have actually gone on to make other investments. One has invested in an Airbnb in a beachfront property. The other has built a 4 unit building where he has 1 unit that is a short-term rental, the other long-term rentals. He's invested in mining companies. So the point is, we've been able to help people really grow into being an investor and redefine what being an investor is for themselves. So the way it works for us is we go out and we find the deal and think about it as, really two different groups. One is the general partnership team. That's the active team. We're finding the deals, we're managing the deals, we're overrunning the deals. I should say overrunning, but we're running the deals. And then you have your LP team. Okay, those are going to be your limited partners or your passive investors. Their primary job is to review opportunities, ask questions, get comfortable, and then make a decision on whether or not they want to invest. Once they do invest, they don't have to do anything else other than receive updates and receive passive income. On the active side, we're in charge of everything. We're in charge of, again, finding that deal, getting it under contract, going through due diligence. Once we close on that property, we're going to oversee the property management, the execution of the business plan, the construction, property updates to the investors, distributions, and then the exit plan whenever we get to that point. So the general partnership team takes the lead. They're running the day to day. The limited partner team is the passive investor. A friend of mine likes to describe it as being on an airplane. You've got the crew whose job is to fly the plane and get everybody there safely, but then everybody else is a passenger, all going to the same place. Some people are in charge of getting you there while everyone else is just along for the ride.
All right. And are all of those people investors in one way or another? Or are some
That's
just
good.
essentially
That's a good
employees?
question. So all the LPs are passive investors. On the GP side, typically we are also investing as well. So, and
Okay.
this is true for most GPs, we're also investing our own money. There's money that has to be invested up front anyway, just to get the deal under contract. But typically we are going to be general partners are going to be investors as well.
And are you, as far as location goes, I don't, help me remember where you are located.
Yeah, I'm in Cincinnati, Ohio. It's not that far from you.
Okay,
Not
right?
that close, but not
Yeah.
that far.
We have crap weather too, right? It's all good.
Yeah, yeah.
So tell me, are you getting apartments or is your target market that Cincinnati, Ohio area? Are you going all over the country, all over the world?
Not all over the world, not all over the country. We do like a tight radius in the Cincinnati market, so 2 hour radius here. But then we also like deals in the Southeast region. So I'm focused on a 2 hour radius of Cincinnati, Louisville, Columbus, those markets there, Indianapolis as well. And then in the Southeast, we're looking more in Georgia, the Carolinas, and then the northern part of Florida.
All right. Well, that's a decent size chunk of the map right there.
Yeah,
That's all right.
yeah. And the way we approach it is, within that 2 hour radius of myself, like I'm really the lead, and we take the lead on finding those deals and opportunities. When we get into the Carolinas, Georgia, and the northern part of Florida, I actually have partners. I have people that I've built relationships with over the years. I let them take the lead, right? They're local, they're close, they've got the relationships. So we'll lean on them to do a lot of that legwork, finding those opportunities, and then bring us in once they found something.
All right. So how did you get into this?
Yeah, man. So, like many of your listeners, I used to have a W-2 job. I was in corporate America and I was doing well. I know a lot of people don't like their jobs, but I loved my job. I was a hard worker, I was doing well. I did advertising and marketing for 15 years. And I was at General Motors, back in 2007, 2008.
Oh,
And once we started going through what essentially became a bankruptcy, it made me really stop and reflect on where I was at, what was going on, and what my future was going to be. I looked at my boss's boss, right? I look around the organization at the executives and I asked myself a very simple question. Who looks happy? Whose
mm.
job do you want? And I couldn't find a single person who I could look at just on a day-to-day basis. I mean, just on the peripheral of how they carry themselves in the office. They all looked miserable. They
Not
all looked
one.
overwhelmed. Not a single one, not at the executive level.
Wow.
There was a guy who did look very happy every day, even though we were going through bankruptcy. Guy still had a smile. His name's Jack. So I would go and spend time with Jack. And one day I think I invited Jack for coffee. And I just asked Jack, I said, hey man, everybody else in here is, you know, the anxiety is killing them. They're all nervous. What's gonna happen? They're walking on eggshells. And you walk in here smiling every day. How? And Jack told me he had a real estate portfolio and he did this job because he liked it, not because he needed it. And that was
Oh,
a
good
huge
place.
illumination for me because it helped me realize that, wow, this guy's doing it right. And it reminded me of Rich Dad, Poor Dad. And I read that book some years prior and the dots just connected. I said, okay, we need a plan B. We need something outside of this job and we need something we can control more. Real estate became the thing. So fast forward, I ended up moving to Chicago in 2012, started investing in my own personal portfolio, scaling and growing from there. And then as I'm building this portfolio, the company I'm working at also goes through bankruptcy. So picture this. You work at this company that goes through a bankruptcy. You do fine. You get out of it okay, but that pushes you to say, okay, I need something else. So you go into real estate. I got my real estate, but I only have whatever I can save. So if I can save enough money, we buy a property, save money, buy a property. Now I've got two small children. The company I'm with now goes into bankruptcy. I have some equity in my real estate, but not enough passive cash flow to sustain me for an extended period of time. So if you've ever had a job and you've had some fear or some level of concern that you could lose your job, you understand emotionally what that could feel like. So that's where I was. I was sitting there knowing that this company is not going to go through bankruptcy, feeling like I had put together a plan, but still frustrated that the plan effectively was working but didn't work, right? Like it was working, I was making money, I grew my net worth, but at the end of the day, if I got fired from my job or if I got let go, I didn't have enough money to pay all of my bills. So
Hmm.
that made me realize I needed to make a small pivot and a small change in how we approach doing deals. I mentioned that I was saving all of our money buying a property, saving our money buying a property. Instead, we said, you know what if we could partner with people? What if I didn't have to bring 100% of the capital to do a deal? That would allow me to do more deals, to scale faster, to partner with more people. And then I remember the friends, the people I told you about who I was sharing that I was doing. And they said, seems like a lot of work, but they had money. And then I was like, oh, maybe we can partner and work together. And once that kind of clicked for me, I went out and hired a mentor, did a lot of education, and ultimately started to scale and do larger deals where I could partner with other people. But my goal was always to go back and think about the folks that I worked with, the friends, the people closest to me, and help them get a little bit of passive income so they had more flexibility and more options. You know, life can hit you at any moment, but we want to be prepared. So for me, the one good thing was because I had started investing when that second company went into bankruptcy, even though I was a little bit stressed, I felt like I had a plan in place. I just had to retool my plan. Whereas I felt there were a lot of other people who had no plan and they really had to start from scratch.
Yeah, that's huge. I mean, I can imagine. Well, I mean, I got a son, and I know I always think about what does it take. Worst case scenario, pandemic, bankruptcy, 2008, 2001, whatever. Insert pandemonium panic thing here. What do you do, and how can you prepare yourself for zombie apocalypse or whatever is going to happen? And a lot of times, it's interesting because W-2 job, I think a lot of people feel like that's their security, but that's probably arguably the least secure thing you can do to be to eat, I guess, as far as that goes. Because it's out of your control. Shy of
Completely
opening
out
up
of
a
control.
typewriter repair place or something like that. You're it's tough,
Completely
especially.
out
I
of
mean, you think
control.
of I'm thinking 2008 General Motors having a very bad day. We have some towns by here that have manufacturing plants, and Janesville, Wisconsin. I think they're still trying to recover from that, and that's what are we talking 12 plus years ago, right? Like it shook them up. So there are people that were probably there for decades and probably got a little letter that they weren't big fans of or something like that. Anyways, tell me when you reach out to your friends, your buddies that got money, and you're like, hey, let's invest in this thing. How many of them were just like, yeah, sure, take my money? And how many of them were like, wait, explain this to me one more time?
Yeah, the best examples, I have two sets of friends who are really close to me, all in Chicago. And one set of friends, we sat down and started just sharing what we were doing, right? Especially after that second bankruptcy. I was like, you know what? I need to be more open. I need to share what we're doing. I need to really let people know how I plan on approaching this real estate thing. So the first group, the first set of couples, or a couple, they were interested. Once we found that first deal, I presented to them. They had some questions. We answered those questions and they ended up investing with us. They went on to again buy that 4 unit and do a mining deal and have some other deals now that they're working on, which is great. The second couple, again, we're all great friends. We spend New Year's together and all that stuff. They look at the deal and they decline. You know, they did not invest. They did not ask me more questions. They just pass, right? So I said, okay, whatever. Maybe my second deal. And I've known this guy since we were interns together. Okay. So
Wow.
second deal, I share that with him and nothing, no interest. So he stays on my email list. I don't bring it up. I don't push it to him, but you know, he sees the deals we're working on. Uh, he didn't do the first two deals, but the third deal, he also did not do. Okay. So not the third, not the fourth. You fast forward. At some point, I again stop talking to him. He's on my email list, still my friend, but I'm not pitching him or anything like that. My 10th deal. he reaches out to me and says, "Hey, I wasn't ready before, but this one looks interesting and I'm ready now. Let's talk." And I say, "Oh, that's interesting because I certainly wasn't expecting it." We had a conversation. He went through his questions, sat down with him and his wife, two of my really good friends, and they ended up investing. They actually have invested in my last two deals and are getting ready to invest in another deal that we have. And the point for me is it's not really about trying to convince my friends to invest. It's about letting them know that I'm here as a resource for them. If they have questions, if they want to do certain deals, I've invested in myself. I've invested in the people around me to provide these solutions, to provide these resources, and I'm here when they're ready. And if they have questions, happy to answer their questions. If they're not ready, great. But also, I ask them sometimes, am I not positioning this the right way? Am I
Hmm.
not telling you the right things? Because maybe we're talking too much about the real estate and the returns, and that's not your challenge. Your challenge might be paying too much in taxes, for instance. I have investors who they don't care about, the rents and the rent growth and all those data points. They are looking at it saying, I'm paying six figures in taxes. How do I reduce this? I heard I can reduce my tax liability if I invested in real estate. Tell me more. I have other people who say, hey, I'm getting ready to retire and I'm going to go from living off of this income to this income, and I need to supplement that. Tell me more about the cash flow. I have some people who have a 20, 30-year horizon, and they say, John, I want to take some big swings and see if I can double my money every 5 years. So it really depends on that individual and what their goal is. But my job is really just to help educate them throughout the process so that they can make decisions that are best for them.
All right. Fair. Tell me, when someone, you mentioned the tax thing, which is something that I have on my list to ask you about. Is that, does depreciation come into play there? Or how do these investments come in, I guess, affect the taxes of
Yeah,
the individual
absolutely.
investors shy of just being income or capital gains?
Well, absolutely. Taxes are huge and it's a big reason people invest. And, for anyone who owns a business, certainly there's things that you can depreciate in your business, especially if there's, physical assets there. With real estate, you've got the building, you have all the mechanicals, you have the materials inside the building. So we can absolutely depreciate this. The way our tax code is written, it says that these things go down in value over time. So we can take that depreciation over time. There's something called bonus depreciation, which allows you to fast forward and accelerate that time frame. So instead of depreciating something over a 27 and a half year time frame or 39 and a half years, you can fast forward it to take all of it in year one. So it's a powerful, powerful tool that investors have been able to utilize to save or reduce their tax obligation. So that 100% bonus depreciation was implemented when Trump was in office. It was only meant to be for a set amount of time, I think 7 or 8 years. This year was supposed to be the first year that it dropped down to 80%, and it actually just got voted to go back up to 100% because both sides of the aisle realize how powerful this is to drive business growth. So this is something that's really exciting for every investor. Now, I do want to give a caveat that in order to fully take advantage of the tax code or this tax depreciation, you either need to be a full-time real estate professional, so you need to qualify for that, or you need to have other passive gains. Now, if you don't have either one of those, it's okay because all this carries forward. So in the future, when you have other passive income gains, you have anything else you need to offset, this can be utilized against it. So it's still a powerful tool. And I think anyone who is looking at their tax situation can leverage commercial real estate investing to help.
Nice. So you raise an interesting point here, and I was just having a conversation with another entrepreneur yesterday about this. We're talking about accountants and how my experience with accountants locally here and their experience were essentially mirrors of each other. Where the accountant just said, "What are the numbers?" We give them the numbers, they plug them in, they send the taxes out, and they move on with their life. And I say something like, "Hey, tell me about," I think they call it segmented depreciation.
Cost
And he's
segregation.
like, "What's that?"
Cost segregation.
"Cost segregation." I say, "Hey, accountant guy, tell me about cost segregation." And he's like, "Oh, that's an interesting question. I'm going to have to look that up."
Oh, goodness.
And then I would ask him about little things like paying my kid, retirement, all this stuff. And I'm having to ask these questions for that accountant to either give me the answer if he knew it or say, "Hey, I'll have to look that up." And it was one of those things where I was like, I feel like I'm playing a Monopoly game where I'm blindfolded and I don't even know you can buy the railroads. I don't know that I landed on the railroads. All they tell me is you owe rent.
Yeah. Yeah.
It's one of those things where I'm like, don't accountants or these people that we're paying to offer a service, whatever that service is, you presume that they're trying to get stuff or do for you in your best interest because they're providing a service. That is totally not the case at all, at least in my experience. So then I'm thinking with you, you got all this stuff, you got investors. I mean, your shoebox has to be huge, right? So how do you find an accountant or a crew of accountants to help you navigate the tax code to make sure that you're keeping all the money that you made, or at least as much as the law allows you to keep?
I'm so happy we're talking about this, man. I'm over here chomping at the bit. I've been fortunate enough to interview other folks as well, and I had a guy come on my show a couple years ago, and he said something to me that completely changed the way I viewed accountants. Accountants are historians. They just document what you've done. What you want is a tax strategist. You want someone on your team who can help you look at your financial situation and make adjustments or investments to optimize your cash flow, to optimize your savings and your wealth. Accountants don't do that. All they do is take, like you said, send me your books. How much money did you make? How much did you spend? Here's what you owe on taxes. See you next year. They don't know these strategies. They don't understand all these things. They get scared when you say certain things that sound bad. Even more, the worst part about it is you have to understand what incentivizes an accountant. An accountant does not want you to be audited. An accountant wants to do your taxes in a way that is above board, easy, no questions, so that it's no more work. As investors, as owners, we want to maximize how much money we keep legally. But if there are ways within the confines of the law to optimize that, paying our children, doing a cost segregation analysis, making a donation, we want to know that when we have time to make those moves, not, April 15th. So it's really important for us to get tax strategists involved so that we can take a look at our financial situation. Hey, how much do I need to make to hit this? At what point do my taxes go up? Okay, what if I did that? You want people on your team that can help you plan from a tax standpoint. So look for a tax strategist, not just an accountant. For us in our business, we have that on every deal. We do a cost segregation on every deal that we're going to hold for, at least 3 years. It makes sense for us to do a cost segregation analysis. And then we're trying to drive and optimize the operations. So our focus is always on the operations of these deals and the properties, but we have a team in place to help us execute that.
So tell me, I mean, that's totally true. That's totally true. The whole tax strategist thing, I never thought about that as a phrase, even. How do you find a tax strategist?
That's what you need to look for. You need to ask. You need to find, I mean, so it's not going to be just the accountant. It's going to be someone who does tax planning. So if you want to look for a tax planner, that may be, a formal title that they have, but you want someone who sits down and actually reviews, almost like a financial planner, but you want a tax planner, someone who sees, here's how much money you made, here's how much you paid in taxes. What did you know if you were able to reduce that tax obligation number here when you jump down to the next tax bracket? And maybe you decide to make an investment. And let me give you a real world example so we have some numbers to play with here. Um, on one of our deals, typically speaking, if you were to invest, I'm going to use round numbers here. If you were to invest $100,000, you would typically get about $50,000 or so in paper losses, meaning that when you go to file your taxes on this deal, we're going to show that you lost $50,000, even though you made money, right? So we're going to make money on the deal. Equity is there. You're probably making cash flow. So you didn't lose any money. But from a tax standpoint, because of the way a tax code is written, and we said that these properties depreciate over time, and we can accelerate that depreciation to take it all year one. By the time we do that, if you invest 100K, you're going to show that you lost somewhere around 50K. Okay. Somewhere between 40, 70K. Let's just say 50K. So now you got a $50,000 loss. that you can take to reduce your tax obligation. So that's a powerful tool to have in your tool belt if you're trying to pay less in taxes, because that 50K might be the difference between being in the top tax bracket and the next tax bracket. So savvy investors utilize these tools and strategies to help them navigate it. So I would look for a tax planner now and say, hey, here's what I expect to make this year. Based on this, what are some ideas you have to maximize what I get to keep and minimize what I have to give away in taxes? Now, certainly some of that may be charitable contributions and things like that, but there may be strategic investments that can allow you to do the same thing. So having those conversations up front will give you more flexibility and more empowerment to make the right decisions so that you can maximize your dollars.
Yeah, I love it. You know, it's so interesting. I was talking with my accountant yesterday, and
Sounds
in
like
the
you need to
back of
stop
my
talking to your
head,
accountant.
what's that?
You might need a new accountant or at least a tax
Oh,
strategist to
you
add to
don't
the
have
team.
to put the might word in there at all. I mean, he's a nice guy, sharp guy, but I feel like if I have to ask some of the questions that I had to ask, instead of him saying, hey, have you thought of this? Or do you want to go down this road? Should I tell you about this? I don't feel like I should be the one asking the questions. I feel like I should be the one getting told these are your opportunities. You don't have to take them, but these are your options. Right? Do you want to
Yeah,
buy Baltic Avenue or do you not want to buy Baltic Avenue? I don't I don't even know the opportunity there. But anyways, I'm talking with them, and in the back of my head, I was thinking, I have learned more from YouTube videos, digging, just going down the rabbit hole, learning about this, including my own podcast, and my guests. Then I feel like either this guy knows or is willing to share, or maybe he knows it and it's just not even crossing his mind because he's like, hey, get this guy out of here so I can get the next client in here, move on with my life. Or like you
yeah,
said, if you pay whatever a huge percentage in taxes, I assume that you're less likely to get audited because the auditor may find out that you need a refund. So, which is probably not what they want, right?
yeah. I think the crazy thing is that most of us rely on certain industries and certain professions to lead, right? Like even when we're using YouTube University, we know not to walk in and lead with that, right? We expect this person to be the expert. So I think of,
Yeah,
our doctor, right? Our doctor or physician, you think of your lawyer, an attorney, and I think of my accountant. You think of those three professions in particular that part of the reason I'm hiring you is because this stuff is above my pay grade and
absolutely.
I'm expecting you to be the expert. And I think it's very frustrating when you don't get that level of service or that level of knowledge and you feel like, man, I can't trust the advice this person's giving me anymore because I'm asking questions and either the answers are giving me they're not informed or I'm getting a roundabout and it just makes you feel like you don't have the right people on your team. And the truth of the matter is, you don't. If they're
Mm-hmm.
not giving you that, like if I go to a doctor and there's a medical condition and he just doesn't take these pills. No, wait a minute. We didn't talk about any holistic solutions
Right.
yet. You didn't ask me about my diet. You didn't ask me about my exercise. Like you didn't ask me any qualifying questions. You just went straight to dosage. So I'm like, I can no longer trust you as my doctor if the first thing you say after getting whatever result is take this medication. No, you need to ask me about my lifestyle. You need to ask me about other things there. And I feel the same with your accountant, right? If you're looking at my numbers and you're just paying taxes, you're just filing them, and you're not asking me or sitting down and having a strategy conversation about, all right, John, what are your goals? Well, my goal is to increase the savings for my kids. How can I free up another $20,000 a year? Like that's what you want. Like most of us, that's what we want. We don't anybody, I can go to H&R Block and have them file my taxes, right? I want someone to help me put more money in my pocket and help me grow my retirement plan or help me send my kids to school. That's what I think I'm getting, right? That's what we all think we're getting when we go
Yeah,
to an accountant, but you're not. So you have to find a tax strategist or a tax planner that can sit down, understand your financial situation, understand your financial goals, and give you some tips and options to help you achieve those.
totally. Totally agree right there. That if anyone's listening here, presuming that they are, that was probably the most important point right there. I want to dig into the types of real estate that you invest in. I mean, real estate, you got single family homes, you got duplexes, smaller multifamily stuff, big multifamily stuff, you got commercial, you got land. How did you end up doing, I'm going to consider it from my point of view, larger multifamily.
All the other stuff you said besides smaller multifamily was a little confusing to me.
All
So,
right. Fair.
uh, you know, I went to a state school. Okay, I'm smart, but I ain't that smart, and I understood real estate from a rental standpoint. I was a renter most of my life. So I pay rent. That rent goes to covers expenses. Whatever's left over is the profit. That's real estate investing at its core. With multifamily, I knew that, well, let's start with single family. With single family, I've got one person, right? I've got one property paying the mortgage, paying whatever expenses, utilities, taxes, insurance, and then whatever's left over is profit. The problem with the single family is if that one person leaves, or I have a big ticket item come up, let's say a water heater or roof or whatever that repair is, that could very easily wipe out my profits, or not just 1 year, maybe multiple years,
Yeah.
and you go from that single family being super easy to manage, no issues, tenants handling everything. And I forget I own this place. The check just shows up in the mail to they move out and oh crap, I got to go over there and I got to fix up this stuff. I got to spend a whole bunch of money. I got to show this place. And it just becomes a job out of nowhere that you weren't expecting. And it feels inconvenient. With multifamily, you've now scaled up. So you reduce the level of dependence on one tenant. So let's just say you even have 10 units. Well, if one person moves out, I still have 9 units paying rent. Okay. And if I have 10 units, one may move out every other month or every third month. So at least we start to have some systems and processes in place to manage this. I'm not surprised every single time it happens. You shoot up to 100 units. Well, now we have the economies of scale. With 100 units, I have a certain amount of units every month that I know I'm going to turn. I have a property manager that's typically on site. I have a maintenance guy who's on site. I can run it like a business. And for me, with my corporate background, that's what I was doing: project management, managing teams, managing big budgets. That's what I did. So think about it from anything else. If I just woke up one day and decided to run one ad, but I had no agency, I had to go out and find people to write the ad. I had to figure out how to buy ads. If I had to do it all from scratch one time, it's really, really difficult. But if you have an entire system and team and processes and revenue to account for it, and this is the business, it's much easier to manage. So for us, going bigger actually made a lot of sense. It's counterintuitive for people, but a 100 unit building is way easier to manage than a 10 unit building because I do have that on-site manager. I do have the maintenance guy. I can look at the projections and the monthly trajectory of every line item. So I was just going through that earlier this morning, looking at our rental income, and our rental income slightly down for February, which isn't surprising. February is a month where it's a little bit, shorter, cold. It's kind of a month that a lot of businesses see a little bit of a dip. And then with real estate, it tends to pick up in the spring. So March, April, and May should be a little bit stronger. But the property's been doing so well that I just wasn't used to seeing the month trailing the previous month. I was like, oh man, the previous month was actually stronger. That's the first time that's happened in like 8 months. So so I was looking, I was like, but it's February, John. That's why I'm like, okay, that's right. But the point is, I can sit here and look at these big budgets and the income statements and make projections based off of that versus if it was just one house, you don't have that level of data. You don't have the resources to manage it that effectively and efficiently. So it actually becomes a little bit harder.
Fair. So tell me, how do you grow from first starting out to getting 50, 100 unit places? Because I imagine you can't just walk up to a bank and say, hey, funny story. I know that I'm a little shy in the down payment, but I want you to know that I am incredibly awesome. So just
Yeah.
lend me a couple $1 million and let's just make this happen.
You just walk in and smile and wait, right? And just see what happens. I think a big misnomer is that regular people can't invest and own large apartments or large hotels or any large commercial real estate. You can. And there are people just like you and I that are out there buying those developments you're driving past in Madison, right? And the strategy that we talked about before, that's exactly how we're doing it through apartment syndication, where essentially we're pulling all of our capital together to go out there and buy these properties. So the way I ended up scaling, first and foremost, you got to start with your mindset. Okay. You got to start with your mind. You have to envision the possibilities. And some of that's hard if you're not in a circle or seeing people doing that. So I think the education and network is the second thing, and they go hand in hand, right? I got a mentor. My mentor started doing some larger deals. I would ask questions about it, see what he was doing. Uh, Try to ask myself, is he doing something that it's hard for me to replicate, or is he an anomaly, right? Is he the Michael Jordan of this, or is there something here that oh I can pick that up and I could probably do it too? And once I realized that I could do some of those things, it made it a little bit easier. You will need a network, right? It's not all my own capital. I told you that's how I started. Using my own cash, running out of my own cash. So I knew I needed to work with other people, but in order to do that, I had to share what I was doing. They had to know I even existed. They had to know I was good. I was capable. I was competent. So that was the thing. You had to show them the track record and show them what I had done and slowly start to scale from there. And then last, to your point, I got to talk to the banks. I've got to go talk to brokers. I have to present myself as credible. So I like to package this up and say there are three C's you need if you're going to scale into commercial real estate. The first C is going to be confidence. The confidence has to come from preparation, right? It has to come from being capable and putting in the work. Even though you don't have the results today, you got to put in the work. You have to underwrite deals. You have to read. You have to listen to podcasts and episodes like this. You have to really get yourself comfortable and build up the confidence that you can do it. Second C is credibility. What in your past makes you think you can be successful? You have to have some credible experiences. For me, it was relying on my corporate experience. I oversaw 7 agencies when I was at General Motors. I oversaw $100 million advertising campaign or advertising budget. I was recognized as one of the top advertisers and marketers in the company or in the country. So I was
Nice.
part of the team that made Buick one of the fastest growing brands in America. So I can look at these things and say, I've had success here. Some of these things are transferable and will relate in real estate. I think I can succeed here. And then the areas where I didn't have that experience or that knowledge, I'm going to supplement that with other people. I'm going to hire great teams, a great property management company that manages 1,500 units. I'm going to hire a great contractor that's done exactly what I'm looking to do. He's built over, 2,000 units or 1,500 units himself. So I'm going to bring in a great quality team. That's going to build up that credibility. Then the third C is connections. I've got to get out there. I've got to network. I got to expand my existing network and get in front of people who are looking for the opportunities like this. So those three C's, confidence, credibility, and connections, that's going to empower you to scale into larger commercial real estate.
Nice. I love it. Three C's. I'm curious when you started off and you're doing your own deals and you're like, hey, money's coming in, but it's not enough to live off of. Did you then end up selling those properties to get into the bigger stuff, or did you keep those and just get other people? I'm curious about the transition. I guess what it comes down to is I'm curious about the
Yes.
transition from the small investor to the guy that's actually got, we have the maintenance people, we have the people where you're not the one actually having to show apartments and all that kind of stuff. How do you transition from just starting out or starting out on the small end to scale? Because it's that
Well,
gray area that I always have a challenge with. Like, that seems like a lot of rungs on that ladder that people are just like, hey, I'm on the top now. The bottom was whatever.
I think it's important to understand what you're trying to accomplish and what helps you get there. So for most people, if you are going to scale into the larger apartments, at some point it does make sense to sell the smaller stuff just because it'll take up your time. You know, you may have built up a lot of equity and, the time you're going to take to go run around and show a unit across town when you could be working on the next deal is just, it gets to a point where it's not worth it, right? So eventually you probably do want to scale and sell off some of those things. But we did not right away. We actually worked backwards. We sold our biggest property first. Part of it
Oh,
was our biggest property at that point was only 8 units. So, but we sold the 8 unit first, and we took those funds and used that as kind of our equity into the next deal, which we used to kind of scale up and grow. And then the other two we sold when they became inconvenient. When the 3 unit, we were getting ready to move out of the city, we're moving to Cincinnati. So I'm like, hey, I don't want to pay a property management company to manage this. Like when I run the numbers on what we make with the property management company, we're barely going to break even. And quite frankly, we have a ton of equity. So it's best to sell now. Let's take out the equity. We can reinvest it. And then the last one we held on to, we moved. We actually had a property management company overseeing it. But it just didn't make sense. We did it for a year. We realized it didn't make sense. I kind of initially wanted a place I could come back to in Chicago, but
Oh,
ultimately just realized that the numbers weren't working. It was more of a headache than it needed to be. Again, we had equity in that property, so we ended up selling it. So if you're local and it's easier to manage, by all means, scale, keep it. If it's providing cash flow or if it helps you in some other capacity, great. Some people use it as collateral. You know, you pay off one of those properties and put it up as collateral for new deals. So there is a role it can play, but I would say focus on where you're going, not necessarily where you've been.
gotcha. Fair. Tell me the one thing that concerns me, not one of many things that concern me in real estate investing when we're talking about scale like this is I always think of one family house. I can sell that. If the zombie apocalypse happens, I
Hmm.
can get rid of a house. If I have to sell a 50 unit apartment building or complex, I guess would be campus, I'm going to have a harder time. So is it, but that's my imagination. I've never had to get rid of a 50 unit apartment building. So can you tell me how that world works as far as buying and selling when it comes to larger apartment buildings or campuses like that?
Yeah, I love that question. So I want to say it the way you said it, then I want to flip it. You said if I have a single family house, I can sell that and get rid of it if I need to. But if I have a 50 unit, it's going to be harder for me to sell that and get rid of it if I need to, right? The flip of that to me is, well, why would you need to sell it and get rid of it, right?
Oh,
If you're selling or getting rid of a house, if it's a house you live in, it's probably because you're moving or something like that. But if it's a pure investment, if it's a rental, you're getting rid of it because it either is no longer performing properly or, something bad has
headache's not
happened.
worth it.
It's not worth it, right? So for a 50 unit, you know, why would you need to get rid of it? And you have to understand this because I think this goes back to what I was saying before when you make these investments. If it's a time commitment thing, if it's a ease of management thing, if it's a cash flow thing, all of these things are one solvable, but there are other investors. And I think the really important thing to understand here is that when you go commercial real estate, and I mean commercial is 5+ units, you're talking to investors.
Hmm.
And there is a bit of a risk because investors are sharks by nature, right? We're looking for deals, we're looking for opportunities. This is not my home. The house you want to get rid of, maybe somebody else sees that as a starter home. So they don't care about the cash flow and the rent because they're going to fix up this house and make it their home. Nobody's doing that with your 50 unit. Okay. Your 50 unit, we all see it as cash flow, appreciation, like we're all looking at it the same way.
Right. That's a
So
business
as
that you're buying.
investors, it's a business. It's a business. So that's why I go back to the foundation. If you're going to invest in a 50 unit, you have to make sure that you know what you're doing. You got in the education, you're surrounding yourself with people in this space. You understand what you're buying, why you're buying it, what your business plan is going to be. And then it comes down to, well, what if you're wrong? If you're wrong, you want to miss small, you don't want to miss big. So we buy what we like to call value add deals. I want to buy something that is already cash flowing, so already making money. I've already looked at the location. I like B and C plus areas. These are desirable locations, workforce housing locations. I want to buy where there's demand. Okay. So I don't buy in anywhere USA. I buy in a 2 hour radius of Cincinnati because I can go and drive and get a feel for those areas. I can look at the numbers and the data and determine, what's the risk factor? What is crime like? What are the schools like? What is the environment like? And based on that, I know what kind of demand there is. So now I can remove the risk of residents wanting to stay there. As long as I can attract residents there who want to pay rent and I can project what those rents are going to be, I've got a viable business. So now I've got to look at the expenses, right, and figure out what those expenses are going to be, manage them. Who can I bring in to help us run this? So then when you look at the downside, there are always going to be people who want to own property in desirable locations. They may have a different business plan or a different vision, but that's always going to be a viable plan over the long haul. Now, if I have a 1 year plan, certainly I could be wrong or miss it. And I think that's what happens with people when they try to flip, right? You might try to come in, buy a property, fix it up, and flip it in 6 months. But we don't know what the market is going to be in 6 months. Maybe you missed your projections and now you're stuck. And then what? If the property doesn't cash flow, you're screwed. So on the larger stuff, I think sometimes we just assume there's more risk, but there's plenty of data to support it. And I'll go back to, my background in corporate America. When I'm running multi-million dollar ads, there was always a risk, right? There was always a risk that
Hmm.
the ads wouldn't go over as well, that they wouldn't sell as much product. But you do it enough, you kind of have a formula. and you kind of have a sense of, hey, we need to pull this lever or adjust this lever. And the thing I love about the larger stuff is you're getting real-time feedback. Let's just go back to 100 units for the numbers to be even. If I project that we can push rents to $1,000, right? And maybe they're at $800 today. We renovate one unit and we put it out there for 1,000, and let's say it only gets 950. Well, I got some real feedback, right? We want $50 off. Now, some people might panic, but the reality is I can now adjust. Okay. Well, why do we only get 950? Well, what if I took this out and took this out and took that out of the renovation? Could I still get the 950? Right? And if I could, okay, hey guys, now we're not spending $8,000 a unit to renovate. We're going to spend $6,000 a unit to renovate, and we're going to get 950 instead of the $1,000. It's a living, breathing business, and you got to treat it like that. And if you're treating it like that, you're going to grow and you're going to be fine. You wouldn't want to sell, right? And if
Right.
you get it to that place, someone will always want to buy it from you. People call me every day about buying one of the properties. So you want to create a thriving business that gives you flexibility. You can always refinance, you can certainly sell, but I would say that the demand on the market is extremely strong in multifamily. There are people who are salivating to own cash flowing apartments. So I
Yeah.
wouldn't worry so much about that side of it.
All right. Fair. Very
You got to
fair.
buy it right and manage it right though, but there's definitely buyers out there.
Finding a manager, that's another question, I guess. I don't know. We don't have a ton of time left, but in the end, that's an employee or a company that you're outsourcing to, going back to the accountant, right? So how do you find a manager? Let's just say go down the employee road. How do you
Yeah.
find a manager as an employee? Because you're talking about
Yeah.
someone that you have a lot of trust in or need a lot of trust in.
Well, trust but verify, you still want to have control. So I would say that's part of the process initially is you want to build your team. So that's one of the things that we always work on, and we're teaching people how to do this. Building out your team is a critical component. And as I just had a call yesterday, we got into this whole thing. There's a very specific set of questions that I want to ask, and there are things that I'm looking for to validate whether or not this person is right. So as an employee, here's the thing: most people, especially entrepreneurs, they're terrible business owners when it comes to actually running HR and empowering their employees to be successful, right? Most people hire you for a role and say, hey, I need you to help with XYZ. They give you maybe 15 minutes of an orientation and expect you to get in there and figure it out, right? And then when you get hired for one thing and they have you doing 50 things that are not in the job description, if you don't even get a job description, right? So that's the hard part. When you look at industries where they do a great job of creating employees and fostering them, they give them the orientation, they give them the resources that they need to be successful. So when you don't have that, sometimes it's better just go with the vendor, go with the company that can actually give this employee the resources that they need to be successful. They have trainings, they have that information. But I'm always looking to see the track record, and specifically the track record of what I'm looking for you to do. If I'm hiring somebody to be my social media manager, show me what you've done managing other people's social media. I want to see the growth, the results you've gotten. If I'm looking for a property manager, I don't necessarily just want to see you manage property because I'm not really hiring just a property manager. I'm hiring a property manager for a specific property with a specific business plan. So I want to see your track record into getting the results I'm looking to get. Going back to social media manager, sure, I could hire somebody who's done social media. Doesn't mean they were good. Doesn't mean they grew any of those accounts. Doesn't mean they did a good job of engaging, right? So I need to look for the results of what I'm trying to get from my business. In the same way, if I'm focused on LinkedIn and that social media manager is great on TikTok, but I don't do TikTok and I don't care about TikTok, that person's not going to be a great hire for me. So I have to figure that out. And the way learned this the hard way, specifically on property management, I had a property, that 8 unit building. I hired a property management company that was very well regarded, came highly recommended from a personal recommendation. Sat down with the owner, had a great interview, and we were about maybe 3 months into the ownership, and I just felt like things were not moving. We had a hard time with the numbers, we weren't progressing. A couple more months went by. I'm seeing expenses for things that didn't make any sense to me, things that weren't disclosed early on. And I sat down after 6 months with the owner again, and we ended up having to part ways. And the truth of the matter is, they were really good at managing B plus, A class assets. They sucked at managing C assets, but it's my fault for not asking the right questions. What they did was they sat in their office They collected rents, which is all automated anyway online. And then if someone had a ticket, they would email them, hey, I got this issue, and they would send somebody out to fix it. Well, I had a property where we had three Section 8 tenants. And for that, we have to do inspections. They got to come out and check everything, the light bulbs, the switches, the outlets. And they would charge me every time they had to leave their desk. So if somebody had to show up on site, they charged me. Well, we had trash on the property. I'm like, hey, how come no one's picking up the trash on the property? Oh, that's not what we do. You wanted us to come out physically and pick up trash. So I realized we didn't hire the right company for this property. They're great at hiring a property where the tenants are going to pick up, not going to throw trash, first of all. So there's no trash that needs to be picked up. But when you have that kind of asset, you need a different kind of manager. So you kind of have to align and understand who you're dealing with.
Got it. Man, there's a lot going on, but it sounds like you got it dialed in.
Yeah, a
John,
lot of work.
I don't want to take up a ton more of your time, but I do want to ask about the investment side. Somebody
No.
throws money at you, they get depreciation, that's cool, all that jazz. Is the idea that they are then in with it? I don't want to say forever because nothing's forever, right? But are they in for a while? Or are they like, hey, after a year, after that deal closes or whatever, they cash out? How does that work? Because then that's just another layer of things that you have to keep track of.
Yeah, typically when we're projecting our deals, we project the 5-year hold period. I would say on average, we're in our deals from 3 years to could go up to maybe 7 years, but 3 to 5 years is kind of where we've been on most of our deals, and that's what we would tell investors up front. So this is an illiquid investment. It's probably one of the worst things is that your money is kind of tied up for a period of time, but we do feel like the projections and returns are worth it for most people. But that's something we would want them to be comfortable with, being in a deal for that amount of time. And then we exit through one of two avenues. One's going to be a refinance, but more than likely, we're going to sell that property. And once we sell, they have shares, so they're going to get their returns, their initial investment back plus some, and they're going to have a nice profit. So they get cash flow distributions while we hold the property, and then when we exit or have a liquidity event, that's when they make the bulk of their returns.
Gotcha. Do you ever hold on to properties for longer periods of time and just have everyone make their little nut every month?
We haven't up to this point, but it's certainly an option. I think we like to let the market kind of dictate it. For instance, we have a property that we have a 10-year loan on it. So we have the ability to hold on to it for another 10 years. The property is doing well. But the reality is most people are investors, and at the end of the day, at some point, investors want their money back, right? To reinvest in other opportunities. There is
Mhm.
the law of diminishing returns. So we try to just keep monitoring all of that. But if we have an asset that's performing well, we certainly do not want to sell prematurely just to sell. So we'll stay in a great deal and then just sell when it makes sense.
Nice. Cool. John, I appreciate you being on the show.
Absolutely, absolutely. I appreciate you having me today. Great questions, and I hope you that tax strategist, man. We got to make sure we got to get those tax planners in
Oh my
place. So.
gosh. Yeah, when my accountant told me what I owe, I was like, I don't need to buy a military jet. I feel like if they're relying on me for a war, they probably got to find somebody else. Cause holy cow. And there's just like, I guess you made money. I'm like, well, you're not wrong. But I feel like there's a lot of other people are making more money and they seem to be paying less. So in the end, it's just the power of your team is what it comes down to.
Can I
Uh,
say one thing on that real quick?
yeah, by all means.
Here's one thing to keep in mind because people don't get this about taxes, and I didn't get this until I had an interview with somebody who completely changed my perspective. The way our tax code is written is to incentivize business owners and real estate entrepreneurs because they want us to provide jobs and they want us to provide housing. Those are the people who get breaks. If you make $1 million and you're a doctor, that's great. We know you're helping society, but you're not creating jobs and you're not providing housing, so you don't get those tax breaks. Tax breaks go to those people who employ others and those who provide housing, period.
Fair. I love it. I love it. I just yesterday was listening to another podcast about because we were talking about tax breaks and ways to minimize your tax. And it was talking about setting up your own nonprofit, 501c, whatever. And then, I mean, that's just another head explosion thing. Like, oh my gosh, right? This is another thing. So it's like you said, hire people, housing, and then share the wealth with the people that need it as far as that goes. So super cool. I love it. John, how can people find you?
Yeah, so listen, we've got a show as well called Multifamily Insights. You can check that out anywhere you listen to podcasts.
Nice. Multifamily Insights. Awesome. And then let's see here. Do you have a website at all?
We do, casmoncapital.com. You can go check that out if you're interested in any of the real estate stuff I mentioned. We have a sample deal package that's available, and you can learn how we put these deals together and some of the terms that are in there and all that kind of stuff. You can get that on casmoncapital.com/sample deal.
Nice. I love it. Casmoncapital.com. And that's AL, of course, since you're not in a Capitol building, but just so that the world knows, right? This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. We are locally underwritten by the Bank of Sun Prairie. If you're listening or watching this on the web, if you could do us a huge favor, give it a big old thumbs up, subscribe, and of course, share it with your entrepreneurial friends, especially those that may be considering going down the path of real estate, which in the end, you probably should, right? You totally should. My name is James Cademan, and Authentic Business Adventures is brought to you by Calls on Call, offering call answering and receptionist services for service businesses across the country on the web at callsoncall.com. And of course, the Bold Business Book, a book for the entrepreneur in all of us, available wherever fine books are sold. We'd like to thank you, our wonderful listeners, as well as our guest, John Casmon of Casmon Capital. John, can you tell us that website one more time?
Yeah, you go to casmoncapital.com and goes /sample deal if you want to check out that.
Awesome. And then remind us of that podcast again.
Multifamily Insights.
Multifamily Insights. I love it. Past episodes can be found morning, noon, and night. The podcast link found at drawincustomers.com. Thank you for joining us. We will see you next week. I want you to stay awesome. And if you do nothing else, enjoy your business.